makers and market movers. This is The Pulse with Francine Lacqua.
Morning, folks. I'm Guy Johnson. Let's talk you through what is going to be coming up on The Pulse and what we're going to be talking about. Tariffs, and the impact particularly on the chip space this morning. Let's check in and see what Nvidia's doing pre-market. We obviously saw a big gap lower first thing this morning in NASDAQ futures, and we're now seeing that replicated when it comes to Nvidia. The stock is down by circa 7%. Pretty similar move that we're seeing on ASML. So we'll come back and talk about both of these in just a moment and try and get an idea of what is happening. It's hard to kind of separate out the ASML story from the Nvidia story, but both fairly negative. The ASML booking story is where the focus is, and it's the restrictions on these H20 chips that we're watching when it comes to the Nvidia story. Peter Elstrom, Bloomberg's executive editor for global technology, joining me around the table. What is going on with these H20s? This was the chip that Nvidia designed to sell to China. As you told me first thing this morning, the Biden administration was already thinking about adding restrictions. The Trump administration is now doing that. How big a surprise, therefore, is it?
Well, this is the third round of restrictions from the U.S. government on Nvidia in terms of selling these AI chips into China. The first came in 2022 and then in 2023. There was talk in the late days of the Biden administration that perhaps they would stop Nvidia from selling this very chip, the H20, into China because many Chinese companies are using this to be able to build their models. Notably, DeepSeek used the H20 to be able to come out with a model that kind of stunned the world a while back. The Trump administration is going ahead. They're saying that they cannot sell this chip for the indefinite future. That's having a direct effect on Nvidia. They're taking a write-down of $5.5 billion in this quarter. An analyst estimate that it could cost them $12 to $14 billion overall. So it's a setback for Nvidia, and perhaps just as important, it's going to motivate Chinese companies to move even more quickly in developing alternatives for these AI chips.
Okay, so that's Nvidia. Let's talk about ASML. Okay. So they make the kit that the chip makers use to make the chip. So in theory, they're right at the start of the kind of the food chain, as it were, of the supply chain. And the fact that we're seeing bookings down as much as they are, is that a canary in the coal mine of what could ultimately be coming down the pike towards the entire sector?
Well, you're exactly right. They're very early in the supply chain. They sell to TSMC, to Intel, to Samsung, to the other chip makers as they try to produce these chips. So they're early in the chain. They would say, though, that these orders, bookings, are lumpy, that they come a lot. I mean, each machine can cost $400 million, so they kind of come in clumps. And they came in well below what analysts had been anticipating. They were supposed to come in at 4.8 billion euros. They came in almost a billion euros shy of that number. So it is a warning sign. On top of that, the company said that there's additional uncertainty because of the Trump tariffs. It's not exactly clear what kind of costs would be associated with that. If, for example, TSMC, as it builds these fabs in the United States, whether it has to pay tariffs on the ASML machines.
That's an amazing part of that story. Peter, great stuff. Thank you very much indeed. Peter Elstrom, Bloomberg executive editor for global technology. Let's come at this from a different angle. President Trump has called on China to reach out to him, pick up the phone, i.e., in order to kick off trade negotiations. The move is aimed at resolving the escalating trade war between the world's two largest economies.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
So the amazing thing here is that, therefore, Trump is reaching out, asking for them to pick up the phone and call the White. I don't know. I'm struggling with this one. Brennan Murray is going to clear it up for me. He's our global trade czar. This sounds like the White House wants a deal, needs to get a deal done. Trump is saying we don't need a deal, but it'd be great if you picked up the phone and called us.
Yeah, exactly. It was a remarkable statement from the podium of the White House press secretary yesterday, delivering this message from Trump directly to China to say, look, you know, we've started off with these high tariffs on you. You've responded methodically. They've cracked down on Boeing deliveries, and they've kind of sort of slow walked this through what has been a flurry of trade barriers barriers that Trump has thrown up. I think what you're seeing is the art of the deal, the Trump style, bring the shock and awe, bring the high tariffs, meets the cult of President Xi Jinping, this idea that I'm not going to be bullied to the negotiating table, and then you have sort of the science of economics going, who can outlast the other the longest. So China is clearly, if you listen to the statements from the government, is not going to be, is not coming to the negotiating table under duress.
Okay. This takes me on to my next question, which is around the rare earths and the critical minerals. So China controls the market. Trump has launched a probe into the market. What is he expecting to find? China controls 85% of the market. I think we all know that, don't we? Is there something that we should be looking for here?
Yeah, I think that the investigation that was launched over the past 24 hours is basically going to lay the legal groundwork for to see whether the U.S. can produce any of these minerals on their own or get them from other sources other than China. And if that can be established, then a tariff wall will have the legal justification for the tariffs that.
But my understanding is that basically China controls 85% of that market. It's built it up over years. It's taken an awfully long time to get to that point, and it's now there and is a source of considerable strength.
Yeah. I think in the meantime, the U.S. or the Trump administration would argue that will buy us some time to go around to our allies and try to figure out a way to shut down China's dominance. So it's three-dimensional chess going on here, and it's going to take months and months to figure out how the outcome is going to play out.
Brendan, great stuff. Thank you very much indeed. So Brendan Murray, Bloomberg's global trade czar. Let's look at this from a European angle now. The European Union and the United States apparently making little progress in terms of bridging their trade differences this week. The Trump administration indicating that the bulk of its tariffs imposed on the bloc will not be lifted. Maroš Šefčovič has just been. We've had talks. Apparently didn't deliver very much. Let's get an update on that meeting with Ollie Crook out of Berlin. Ollie, what happened at this meeting, if anything?
Yeah, it doesn't seem like a whole lot happened, right, Guy? I mean, this is sort of the week of the charm offensive for European sort of policymakers and emissaries and diplomats. It started with Maroš Šefčovič, then it was the Spanish economy and trade minister, and then tomorrow will be Giorgia Meloni at the White House meeting directly with Donald Trump. But that main meeting, the one that really has the mandate to negotiate any kind of trading deal with the United States, is Maroš Šefčovič. And that meeting happened on Monday. It lasted for about 2 hours. And within those 2 hours, I think it seems like Maroš Šefčovič left that meeting with as many questions as he came into it with. There is still not a clear idea of what the Trump administration is, what the Europeans are negotiating with in terms of the non-trade barriers. Remember, this is the thing that we keep hearing from the Trump administration. They have not laid out very clearly what it is that they want the Europeans to change in order to get a deal. But I think even worse, it casts a doubt on what a deal could even look like, Guy. We know already you have those 25% tariffs, aluminum, steel, autos. Is the Trump administration really willing to even move on those? And as for the 10% reciprocal tariff, right, this is the one that's been dropped down to 10% for 90 days. What are the Europeans exactly negotiating here for? Are they negotiating to bring that 10% down, or are they negotiating to preserve that 10%? Because after 90 days, that will shoot up again to 20%. Again, all in sort of theory right now. So again, as far as negotiations work, as you know, Guy, you need to know what the object, what the prize of the negotiation is. Then you need to set a price. We have done neither of those things. We'll see if Giorgia Meloni can make a little bit of progress on that tomorrow with Donald Trump in person.
In theory, they should be maybe more ideologically aligned. We'll see whether that meeting tomorrow at the White House that the Italians have been so preparing for delivers anything. Ollie, thank you very much indeed. Bloomberg's Ollie Crook out of Berlin on the latest on the European side of all of this. Let's try and pull it together from a global perspective. Perfect person sitting next to me, Janet Henry, Global Chief Economist at HSBC. Good morning.
Good morning.
Is it possible to have a base case at the moment?
Well, we're economists. We have to have a base case. But I think...
You come with pretty big tails, though.
Very big tails. And I think, obviously, this is the challenge facing a lot of investors. You know, they have to take decisions to invest money based on either a central case or some hedging around it. But I think we are now in a world where basically anything could happen.
So what do we... How do you plan... How do you produce a plan for that? If anything can happen... And say you're a central banker, you're trying to figure out what to do. So let's kind of, you've got the ECB tomorrow. Yep. Bank of England's looking at the data it's got this morning. The Fed's trying to figure out what it's going to be doing as well. We're going to hear from Jay Powell a little bit later on. what do they do? Like, this is a genuine question.
Yeah.
What do you do in this kind of world where you don't know what your tariff input kind of story is going to be? You don't know what the global economy is going to be doing. It's hard to model this stuff. You've got huge tails.
You think about what your mandate is. And for most central banks, your mandate is to keep inflation at acceptable levels, which in most cases is around 2%. Obviously, the Fed has to try to...
mandate.
Well, not...
Employment.
Employment. So they have to balance the unemployment with the inflation.
Yep.
So everything they do has to come back to that. But they also have, I guess, another mandate, which is financial stability, which can interfere when you are trying to achieve inflation. And, of course, we think back to what happened in the infamous Liz Truss moment not so long ago. And that's why we've even heard comments from Fed governors in the course of the last week that, yes, of course, they stand ready to respond to any financial risks out there. But basically, in a world of huge uncertainties where a lot of policies are being delivered, which may lead to an acceleration in prices, it's all about keeping inflation expectations anchored, making it clear to everyone that they value their credibility and that they are going to manage inflation irrespective of what happens. But that means they'll keep looking at the hard data. They won't be steered by what these pretty awful survey data are saying about the outlook.
Is the hard data going to follow the survey data?
Well, we don't know for sure. Because if you think about what happened, if you go back to when we saw the first upsurge in inflation, it was a case that actually inflation was starting to build, US consumer spending was very strong, the survey data was saying things were going to slow down. And now, of course, with hindsight, everyone's saying the Fed waited too long. Well, they waited too long because the survey was telling them that things were going to soften. But actually, the massive policy stimulus that we got on the monetary and the fiscal side, and people couldn't wait to get out of spend, led to that upsurge in inflation. So I think at the moment, that's why there will be caution from the Fed in particular, but also from others. All the data they're getting at the moment is all pre-April 2nd. So they're going to lag, if anything.
Do I need to separate out from a central bank point of view my thoughts on financial stability and the economy? Because I do slightly wonder whether they're beginning to diverge. Particularly, my example A is the US 30-year at the moment, which seems to be a buyer and seller issue rather than a macroeconomic issue that's affecting that market. But as you say, it does have a big effect back into the economy because mortgages are set and all kinds of other things are going on around that. Susan Collins talked about the idea that we could step in, we could help out if there is a problem here. How high is the bar for that, do you think, from the Fed?
Well, it depends how far they ultimately have to go, and indeed whether the markets themselves force a change in US policy responses. I think most people would agree that the very quick U-turn within a few hours of what happened on April the 2nd was that it was the power of the markets that made a massive contribution to that turnaround in activities. But I think if the central bank finds itself having to respond to financial stability, initially they might hopefully be able to start small in terms of liquidity provision. But absolutely, if you get a tailspin...
QE is on the table. So back on the table, do you think?
I think all instruments are on the table at any point. Should they be required, they would hope that to some extent you get back to the Mervyn King Maradona days, don't you? Where actually the central bank doesn't always have to do a huge amount because the markets anticipate what they might do and the markets themselves can impact on the economy. You mentioned the impact on the corporate sector, the household sector. For the corporate sector, the cost of capital has risen. You've seen the equity markets, you've seen the bond markets. That impacts on the macro outlook. It impacts on investment spending. It impacts on lending. And ultimately, that will impact on hiring. So, yes, it's all part of how the Fed is viewing the economy.
I'd take it one step further. Draghi didn't even have to do anything. He just sort of talked about it.
But talked very well.
But here in London. But how big a danger is there that you could have to see big QE again? Like, is that something that is on the table? Is on the table. Who is going to buy all these treasuries is a question that I'm being asked time and time again. People are talking about it. And I'm wondering if ultimately, and I've had 2-3 conversations already this morning about this, could it be the Fed?
I think it's We're not there yet.
Yeah.
At the moment, we are still in quantitative tightening. We've already seen some tweaking around the edges in certain areas, and it's always about, the longer we take the QT, the longer it can happen for.
Yeah, the Bank of England's backing off.
Bank of England, it was kind of, this is technical.
Yeah.
It's not about monetary policy decisions, but it
Precisely.
did follow the sell-off in the gilt market. So everything, as I say, is possible. But when you think about the treasuries, in particular, maybe 30% of the treasury market is held by foreigners, the difficulty you have at the moment is the inconsistency on what the US is trying to achieve.
Yep.
They want to eliminate the trade deficit, which is not going to happen without a multi-year deep recession.
Yeah.
They want to have lower treasury yields, and they want to have a weaker dollar. They have to decide which of that impossible trinity they are not going to actually seek. But ultimately, you will have buyers of treasuries. It's at what price? And at the price will matter, because that will matter for the yield, which will matter for the real economy, which is what the Fed and central banks have to ultimately worry about.
I feel bad that I haven't talked a lot about Christine Lagarde here. The pound's coming up a little bit later, but Lagarde's coming up tomorrow. What message does she send tomorrow? What does she need to communicate tomorrow about what the ECB is doing? And the divisions that exist, and as you say, that the ECB in theory has got a single needle in its compass. Trichet, it is inflation.
Yes, it is, and it's about price stability. What she has on her side at the moment is that actually a lot of what's happening in the world, if anything, should mean that inflation gets back to target a little bit more swiftly than was previously the case, because the euro is a bit stronger, oil prices a bit lower, and of course you've got this whole possible disinflationary influence because of trade diversion, as perhaps not as many China products are going to the United States. But I think it will still be carefully as we go. Over the last few weeks we did have a few ECB members talking about caution. I think the key message that will probably come out of their statement is that policy in the eurozone is no longer restrictive. They talked about their kind of neutral range. We are within the range. The markets will be desperate to know, but what about June? Are they going to cut rates in June? And how far are they going to go? And I'm not sure we will get a strong steer in that regard. Again, uncertainty, enormous uncertainty. No one knows what's going to happen on tariffs. And actually, they will be thinking about the medium-term fiscal impact. So it will be, we're neutral, we're going to wait, we're going to watch the data, and then we will act.
Is the ECB's job, though, easier than the Fed's? I'm assuming it has to be.
Yes.
They appear to have more visibility. Therefore, the potential for cuts are greater. Is that the way I should think about it?
Well, the potential is greater, but the ECB has already done quite a lot. But you're right in terms of the mandate. For the Fed, they know that growth is going to be weaker and inflation is going to be higher, but they will have to balance the two. They probably think that growth is going to be a bigger impact than potential upside to inflation, but at least that, they are moving in the opposite direction. For the ECB, this is bad for growth. And if anything, this will lower inflation. So at least both of those indicators are heading in the right direction. So in that way, it is more straightforward. But at the moment, they don't see the need for really aggressive rate cuts because they know they've got this fiscal support. But actually, we don't know what's going to happen on the fiscal side in the US in 2026. We've still got this budget appropriation bill coming through.
A base case with fat tails. That's where we started. Janet, very nice to see you. Thank you very much indeed for stopping by to see us. Janet Henry, Global Chief Economist at HSBC. Coming up, we're going to talk about what is happening in the UK. We didn't talk about that. UK inflation slipping back for a second straight month. It comes just before we see bills, utility bills, every other kind of bill, it seems, going up. So I'm just wondering how useful this data is as well. Anyway, we'll come back to that in a moment. This is Bloomberg. Welcome back. You're watching The Pulse. I'm Greg Johnson in London. Probably just worth pointing out, Nasdaq futures don't look particularly clever right now, down by 2.15%. That sounds like a lot, but actually in the reality of what we've been living through recently, maybe a 2% move on the Nasdaq isn't that bad. I'm not sure how many standard deviations we are off the normal, but I wouldn't have thought many. Let's talk about what's happening in the gilt markets. A little bit of movement this morning. We saw inflation data slipping back for a second straight month, but I don't know. Anybody that has looked at their doormat recently has probably seen some letters coming through from utilities telling you that your prices are going to be going higher. So can I ignore this data? Are the data coming through next month going to be higher? And what happens after that? Well, let's try and answer some of these questions. John Stepek joining me around the table, author of Money Distilled, the newsletter that we have here at Bloomberg. Can I ignore these numbers? Are these numbers actually useful in as much as probably they are more aligned with what the longer-term picture looks like? Next month, inflation is probably going to go higher. I don't know. Tell me what's going on.
Well, I mean, OK, so inflation this month has been a little bit lower than expected.
Yep.
Now, so this month, obviously, is April. Next month, we get the April inflation figures. They are definitely going to go up 3%. They are probably going to go to something like 3.5%, maybe even a bit higher than that.
After that, though?
After that, though, you're probably talking about it staying around about the threes for the rest of the year, assuming that, you know, things stay roughly where they are just now. I mean, I think the important thing is that this has been, you know, this is in the price. People have been expecting this.
Sure.
The Bank of England expects inflation to go up to 3.7%. That was according to the last, monetary policy forecast. They've got one in May. The good news for the bank is that they're going into the May interest rate setting meeting with people's minds on the 2.6% inflation reading we've just had, rather than the 3.61 we're going to get after their meeting's over. So I think they've got a lot of political leeway at this point to cut rates. To
the government would be very happy.
Yeah, exactly. But I mean, I think the other thing you have to remember about the bank is I think the bank is cognizant of what things look like because they think about expectations. It's one thing to cut rates to 4.25% when inflation is officially at 2.6. It's a bit trickier whenever inflation's actually officially at 3.7.
How can you have a credible mandate of 2%? How can you be credible at 2% when you're cutting rates and it's at 3%? What does that tell me about the reality of a 2% target? Can I give up on that?
It's a useful fiction that was pulled out of the hat of the central bank in New Zealand
more and more
in the 1980s. Yeah, but I mean, I think that the problem with all these things is you can't. We assume too much. And I think what it does tell us is that our fundamental models of the economy are not very good. The idea that, the Bank of England just sits there and twists the dials this way and that, and somehow it can get inflation back down to 2%. I mean, also, you talk about long and variable lags and the old Milton Friedman thing. It's going to take 18 months for this stuff to take effect. So the Bank of England has got to reserve the right to be able to look through the data, even though the data is actually, it's kind of messy and it doesn't look great. What I would say is that if oil prices have collapsed in the last, couple of weeks.
Where are we, 60-something? Yeah.
60 odds, even down to 50 odds at one point in Brent. And actually that fed through even to this particular one. And next month it should take the edge off as well. And also you've got the Trump tariffs are probably, Britain's probably one of the least badly affected countries by whatever happens with that. So, it's not a disaster.
This is John being upbeat, by the way.
This is my optimistic face.
This is him being optimistic, just so you know. John Stepek, thank you very much indeed. We're going to talk chips. We'll get back to that story next. This is Bloomberg. Welcome back. You're watching The Pulse, half past the hour. Equities are under pressure. Chips are at the centre of that. We'll come to ASML in just a moment. Before we do that, I just want to bring you a line that's coming out of China right now. China is open to talks if, and here's the big if, Trump shows them some respect, which is critical for Xi Jinping, and also names a point person. But maybe a crack appearing on the Chinese side and the possibility of talks opening up. Remember, yesterday we had this line out of the White House, basically the Trump administration asking the Chinese to pick up the phone and give them a call. The Chinese are prepared to do that with some conditions. Anyway, we'll come back to that in just a moment. Let's talk about what is happening with the market this morning. Under pressure a little bit on the stock front. The reason for that, we are seeing certainly the chip sector under pressure. There's a whole bunch of things that are happening here. ASML is under pressure. First quarter orders missing estimates. Nvidia slumping in pre-trade on those new China export restrictions that are coming through from Washington. In terms of the bigger story, tariff talks between the US and Europe appear to be stalling. Sources telling Bloomberg that US-imposed levies on the bloc will not be removed. Plus, President Trump says the ball, as I've just been saying, is in China's court to make a deal on tariffs. This as Chinese GDP growth beats expectations. A bit of front-loading maybe coming through from exporters. Let's get back to the chip story. We'll come on to the China story in a bit more detail in just a moment. ASML is down pretty hard this morning. Let me show you some numbers. As you can see, we are seeing losses across the piece when it comes to the chip sector. ASML, lithography maker, makes the kit that chip makers like TSMC use to make the chips that ultimately companies like Nvidia need. ASML reporting bookings of just under 4 billion euros in the first quarter, nearly a billion shy of estimates. Charlotte Hughes-Morgan joining me around the table. I've heard a number of people this morning talking about the fact that ASML's numbers are lumpy. These are big pieces of equipment. They are hard to kind of send around the world, and therefore orders tend to come in kind of lumps and bumps. Is this more than that?
I mean, totally. Well, that's certainly what ASML says. You know, these are lumpy figures. The lead time on these machines can be 12 to 14 months. But, I mean, you look at the shares, down 7% at the open, I think still about down around 5%.
Would they have been down? Nvidia was down pretty hard already.
I mean, I think you've got a double whammy here, right?
Yeah.
I mean, you've got the Nvidia news that's obviously putting pressure on the entire kind of sector as well. Yeah. But ASML, you know, these results were the bookings, which are the most closely scrutinised metric, are down by 1 billion euros compared to estimates. You know, that is a disappointing result for them, and it says a lot about, you know, customer demand, and investors are kind of having these conversations about whether the AI boom, this kind of huge momentum we've seen, can really kind of continue. And then on top of that, we've got obviously the tariff uncertainty that ASML themselves flagged. I read the statement this morning. They're pretty confident on the AI story still. They are. They've been doubling down on this. They're saying, look, we're having conversations with customers. 2025 and 2026 could be growth years. They're looking like growth years. AI is really driving the growth in the sector. So that's what ASML is saying. But, you know, we've seen analysts, we've seen some investors kind of flagging potentially there's some softness down the line in this market. You've had Microsoft walk away from some big data center projects recently. So you've got kind of two schools of thought here. But ASML, for their part, are saying AI is really driving this. However, across their whole results today, they have said, you know, there is this huge uncertainty hanging over the sector in terms of tariffs and trade tensions. And actually, OK, yes, if actually we were to see a recession or, tariffs were to start impacting spending, decision-making at their main customers, Intel, Samsung, TSMC, as you mentioned, if that was to start happening, well, then obviously that macro volatility would impact demand for their machines down the line,
Great to see you, Charlotte. Thanks very much indeed for stopping by to see us and updating us. Charlotte Hughes-Morgan on what is happening in the chip space. Nvidia is down, as we mentioned. They're all down. Hard to kind of separate out exactly what is moving what, but certainly Nvidia was down heavily after overnight. And we're seeing pre-trade this morning down by, let's call it circa 6%. The company revealing, so this has come from the company, not the government, the company revealing that it is facing new US restrictions on chip exports to China. We're talking about the H20 chip here. So the Trump administration has barred the sale of the H20, this chip which Nvidia specifically designed to comply with US regulations so that it could export them to China. Ipek Ozkardeskaya, senior analyst at Swissquote, joining us this morning to talk about all of this. How easy is it to invest in a space where I don't know what's going to happen day to day? The beginning of this week, the news around Nvidia sounded really positive. But here we are Wednesday, and we've got really negative news coming through. And I don't understand from an investment point of view how you get the visibility you need to make an accurate kind of investment into Nvidia or the wider space.
Well, it's because it's impossible to say anything that's going to happen by next hour. So the uncertainties are such right now that the investors are totally paralyzed. We don't know what's going to happen in the next hour, in the next days, and the next months. The only thing we know that the uncertainties are actually leading companies to delay their AI investment decisions. And this is what we saw in ASML orders today. And we think that this instability and uncertainty environment will last at least for the next 3 to 6 months.
So let's talk about ASML. As you bring it up, and as you say, you think it's going to last, the uncertainty is going to last for quite a while. What is the lag between ASML having a weak order book, a weak bookings number, and that then feeding through into TSMC? We're going to hear from TSMC tomorrow, and then ultimately the end consumer. How long does it take for this process to unfold?
Well, it's quite long because ASML is selling machines to companies like TSM to build the chips, and then Nvidia is making their chips built by TSMC, and at the end, the chips are being sold to the end client. So we do have a couple of months, there's 10 months there of lag. But at the end of the day, what we see is that the orders should come today in order for the companies to get their orders when they, well, initially thought they would. And right now, all the supply chain and all these outlooks is being pushed forward by at least 3 to 6 months, because we don't expect the dust to settle anytime soon, and the headlines are getting hectic and more hectic by the day, and no one really knows what's going to happen again, not for the chips, but for the entire geopolitical and the trade tension. So the fact that the tensions are escalating and we don't see through what's going to happen is having a material impact on appetite, both from the businesses who are delaying their investment plans and both from the investor side who are not really sure that even after the pullback that we saw in valuations, it's a good time to invest.
So what do you do? Is this sector, so this sector is investable still? How do I think about putting money to work in the tech space? What do valuations need to get to? Multiples are still reasonably punchy, and I've got this huge amount of uncertainty.
Well, it sure is. We think that the AI demand is strong and it will remain strong. It's just a temporary push, a temporary delay in investment decisions. So I think that's very important to understand. Right now, we think that holding the U.S. technology stocks and trying to hold through the turmoil is a good idea. And we think that diversification towards other geographies and other continents is also a great way to deal with the uncertainties, especially regarding the geopolitical uncertainties and trade uncertainties. This being said, again, the AI demand is strong, and when we talk with investors, the only thing we hear is how fast this revolution is happening. They're all saying it's happening so fast that you don't have an idea. So many companies are still very much interested in AI solutions. Yeah. It is just that right now we don't really know where to invest and how to invest in the middle of this trade uncertainty.
Can I ask you another question, looking at it from the Chinese side? DeepSeek obviously sent shockwaves through this entire sector. Does removing Nvidia, the H20, from China slow that process down? Does it cause a threat to the threat that China poses to US companies in particular? Or are we going to see an acceleration, which is in some ways Nvidia's argument, in China's ability to produce chips that can deliver the kind of performance that is required for China to be competitive and competitive at a cheaper price? How does that unfold?
Well, both. In the short run, we think that there is going to be a negative impact of the export restrictions towards China. So there will be an initial shock. But again, this is going to force the Chinese to step up their efforts. And Chinese have actually come through with quite interesting and efficient models. And they do have technology giants, and they do have means to get there. So we think that the developments on the Chinese side are going to be very interesting, because the government will also put all of its weight behind the technology sector in order to not get laid by the tariff and the trade war that's unfolding right now. So we think that what's happening right now between the US and China could be benefit to the Chinese technology sector more than otherwise.
Ipek, thank you very much indeed. Ipek Ozkardeskaya, senior analyst at Swissquote, joining us on what is happening in the tech space. The earnings season is beginning to gather a little bit of a momentum, and you want to keep an eye on what is happening with the credit space as this whole story unfolds. Let's try and get some analysis on what we're looking at right now. Mahesh Bimalingham joins us now, Global Head of Credit Strategy for Bloomberg Intelligence. What are we looking at credit spreads in Europe have gone from extremely tight to being kind of averagely tight. Is that a good place to enter the earnings season that we're about to see, when potentially we're going to see a lot of withdrawal of guidance and we're not going to have a lot of visibility going forward?
Yeah. So we were priced to perfection, basically, at the end of Feb. Even before Liberation Day, we had a small correction. So, for example, if you look at junk, we widened by like about 50 basis points. But in the Liberation week, we widened by like 100 basis points, so 150 wider. So we went from price to perfection to very cheap in like a month and a half, right? So now, as you said, we stood moderately tight, No, I think we're moderately cheap right now.
Okay.
So it is not...
In high yield or in IG?
Both. High yield, lot more.
Yeah.
Lower ratings have really sold off. Liquidity has really come down in the bond space. So costs have gone up, volumes have come down, and CDS volumes have really like doubled, tripled. Because people are hedging and they can't get rid of bonds in a downturn, for example, right? So lots of hedging going on. So where is credit right now? It's definitely not flashing any red warning signs. You're talking about the earnings cycle. So where are we as we enter? Right? So last quarter, we saw the first signs of small slippage in high yield. So if you're in the high yield market is obsessed with leverage, for example. So the leverage stats slightly slipped in the last earnings cycle. But remember, this comes on the back of 3 quarters of improvement.
Okay.
In investment grade, we continue to see improvement. This is before tariff season.
Yep.
So I do see some slippage in this quarter because the impact of tariffs wasn't seen. The slowdown wasn't seen. So we enter the earnings season in that mood.
Okay. I got a couple of quick questions I need to follow up with. The first one is what I'm hearing is that particularly in high yield, bid offer is still pretty far apart.
Yeah.
And particularly the bid. Like people are putting some pretty aggressive downside bids in at the moment. What kind of visibility is that telling us about what comes next? If the market is still jittery in that space and the bids and the spread is still pretty, the bid offer spread is still pretty big.
Yes, I mean, is it like a complete crisis where you're not seeing
bids?
In a bid? It's not that bad.
Yeah.
But definitely bid asks have gone up both in investment grade and high yield. High yield a lot more. We do track credit liquidity quite aggressively, like month by month, and we saw that round trip costs. So buy and then sell any given bond, that has gone up. Volumes have really dropped. Do I believe that this is going to improve? It depends on any sort of relenting and things getting back to normal on that front. This is on the liquidity side. Now, liquidity is also impacted by supply.
Sure.
And supply.
This is my second question. Okay.
So supply has been impacted by, I'm assuming.
This is primary supply,
Correct.
Yep.
So thanks to what has happened in this crisis is the refinancing premium really, really went up.
Yep.
Right? Substantially went up. Particularly for high yield, it went from 27 basis points to like 140. In investment grade, it went from about 55 to 95. That has led to big drops in net supply. So high yield, we're used to having like negative net supply. I mean, the market has been suffering for some time. But the big story is the investment grade net supply, the chart that has just flashed up. We've had the worst net supply in a month ever since 2006. Now, the month is not over, I admit that. So we might see some supply coming in. But the point is, the incentive to reissue has come down. When I say refinancing premium, what is that? It's the difference between the cost of a new bond versus an old bond. That number has shot up big time in high yield. So I don't expect much gross supply there. Even in investment grade, it has got worse. And you're seeing, we saw only 6 billion gross index eligible. While we saw like about 50 billion, 45 billion exit. That's why we are seeing net supply minus 40. It's unheard of. Even during pandemic, we didn't have that sort of a negative net supply number.
Tells you about maybe what is coming. Mahesh, we're going to have to leave it there. Great stuff. Thank you very much indeed. Mahesh B. Mellingham joining us on what is happening both in the primary and the secondary market on the credit side. Let's talk about what is happening in China. We'll talk more about this coming up. Apparently China says it's open to talks with President Trump, but setting a few conditions. Some respect maybe is required here. Anyway, we'll bring you the latest on that next. This is Bloomberg. Just looking at dollar CNH, a little bit of movement in that on the headline that we brought you a little while ago saying that China is is open to talks. Remember, yesterday you had the statement from the White House talking about the fact that the White House would like to see China pick up the phone and start the process. China's saying it could be open to that. The US needs to show a little bit of respect and maybe rein in some of the cabinet members that are talking about this relationship. So you are getting a little bit of movement, so a weakening just slightly at the margin of the US dollar versus the CNH. Let's bring in Alan Wong, Bloomberg China economy and government editor. Alan, how should I read this statement?
Right. The first thing to know, I think, is that China has always been saying that it is open to dialogue. But then, obviously, there's always the fine print. And China has always framed its openness to dialogue as a willingness to talk, as long as it is based on equality and respect mutually. But we are able to report today that China is open to talks with a little more specific conditions attached to it. First of all, as I said, China is demanding some respect. And specifically, it basically wants the Trump administrations to rein in some of the cabinet members who makes disparaging remarks about China. And then the other more specific conditions is that China wants the US side to appoint a person that it could have those talks with, which is understandable because we've seen how different members of the administration have said different things over the course of the last couple of months. And China is frustrated that it doesn't really know what the US wants from this negotiation. And this person, as long as he could or she could put together a deal that both presidents could put their names on, it's our understanding that China didn't designate anybody.
Okay. That's really interesting. But isn't the issue with that we ultimately see Donald Trump being the final arbiter of what the US side will accept? And isn't that the problem that we face here, that he's obviously thinks of himself as a deal maker and probably wants to be pulling the strings? Aren't the Chinese ultimately just going to be dealing with Trump? Isn't that the level at which this needs to be sorted out?
Yeah, I think we all know that Trump likes to deal with other leaders one-on-one to get them together in the same room and just hash it out between two leaders. But that's not how China normally operates here. And the bottom line is that China wants to deal with someone who actually represents or knows what Trump wants, so that any negotiation will have a meaningful outcome.
Yeah. That may be the challenge at the moment. Alan, thanks for the analysis and the insights. Alan Wong, Bloomberg China economy and government editor. Phoenix Kalen, head of emerging market research at SocGen, joining us now to discuss all of this. Phoenix, how close do you think we could be to a deal between China and the United States? Still feels fairly far apart at this point.
It's difficult to tell. I mean, sometimes we think that deals are going to take months and even, years to negotiate, and then you turn around and things happen within 12 hours. So it's head spinning. It's kind of a soap opera type situation that's unfolding before our eyes. So it's quite difficult to determine. I think in terms of the tenor of discussions and kind of the language that's being spread out, then I think there is a chance for deals to be conducted over the next couple of months.
Does that have to happen at the sort of the ultimate level, i.e. between Xi Jinping and Donald Trump? Is that the level at which this needs to be sorted out? The Chinese are talking about the Americans appointing a point person. But these two leaders they're giants in their own worlds, and I'm wondering whether or not it is something that can only be sorted out at that kind of level. Do we need to see a summit at which we see a big deal being thrashed out?
I think definitely on the Trump administration side, it is something that I think Trump will need to sign off on. He wants to be completely hands-on in each of these negotiations with each country, not just with China. And he wants to put his stamp on it and kind of his seal of approval. And definitely on that side, I think Trump is going to be very proactive. I think on China's side, President Xi will want to engage his cabinet and take a much more kind of collective decision with, yes, of course, with him being the leader, but I think the approach on China's side is going to be much more long-term in perspective and much more sober.
In terms of how we think about where the world goes from here and the kind of the progress that we are seeing at the moment, I've been fascinated to see Xi Jinping going around Asia this week, trying to secure an economic sphere of influence. At the same time, I'm hearing the Treasury Secretary in the United States, Mr. Bessent, talking about kind of economic containment of China, using the trade negotiations that are currently being conducted to set up that kind of ring fence around the Chinese economy. What kind of a world are we heading into? What kind of a world are you looking at in terms of emerging market investing if we are going to see that kind of fragmentation?
Yeah, I think given the kind of expression that especially Bessent has articulated in terms of wanting to isolate China first, partnering up with various trade partners, carving out deals first, and then approaching China as a group to isolate the country, then I think it sets China up to a situation where they have to go around the region and shore up as much support as possible. And so we're seeing kind of the extension of bamboo diplomacy happen in a lot of places in Asia. I think that is going to continue. And it'll be so difficult for a lot of the smaller economies to try to walk that fine line between, having a strong relationship with a huge trading partner like China, who's so close by, and at the same time not isolating the U.S. export market. So I think they will try to do that, but it will be just so very, very difficult. And it's maybe one where they can commit to certain types of obligations and promises to the U.S., but at the same time not try to overstep the boundaries with respect to what that means for Chinese investments and Chinese FDI in their countries, for instance.
Can I ask you a question about the currency? If China wants a sphere of influence around it, if it wants to have some stability in its own backyard, presumably having a stable currency is part and parcel of that. But at the same time, on the global stage, maybe there is a need to weaken the currency, maybe not at sort of destabilizing rates, but to weaken it. How does China balance those two factors?
So at this point, I think China really wants to step up as in contrast to kind of the image that the U.S. is presenting as being somewhat of a wrecking ball. China wants to be that image of stability, and part of that is going to be currency stability as well. And if we have a shock in terms of any kind of massive deval to the currency, that is going to hugely impact consumer confidence, hugely impact Chinese assets. So I think that's kind of off the table for the time being. That's the least preferred option, even though that might, kind of at the margin help exports. So I think the step is going to be maintaining relative stability in the currency, maybe very managed level of currency depreciation, very, very weak kind of, progression toward kind of a slightly higher dollar CNY over the coming months, but very managed in a way that's not going to destabilize sentiment in the country and still firm up confidence. So I think that's still key, and also projecting kind of the image of global power as well.
Felix, great to catch up. Really useful to get your analysis and your take on what is happening here. Felix Kalen, Head of Emerging Market Research, joining us from SocGen. So that's it. That wraps up the Pulse. Danny Berger up next with the brief. Markets at the moment look like we are seeing weakness, certainly on the equity front. You've got chip stocks particularly under pressure. We're heading into, obviously, a long weekend as well. Lots coming up in terms of the thinking around the risk management story around that as well. Arsenal going to Madrid tonight. That's also a fairly big story. Can you defend a 3-0 lead? This is Bloomberg.